The macro outlook for 2019 appears to be pretty steady. Already, the April to November fiscal deficit has come in at a huge 114% of its target. As well, in an exclusive poll of top economists in the country conducted by CNBC TV 18, 50% of the respondents say they expect the second half of the GDP to be below 7%, but they expect FY20 GDP to be above 7%. 81% of the respondents believe that the range for the rupee is going to be pretty steady. 69 to 72 against the dollar. That's for 2019. And every person we polled said there could be 1 to 2 rate cuts by the Reserve Bank. So that looks like a fairly bullish state of things. For one thing, there is growth, 7% plus for FY20 and possibly 2 rate cuts. Rakesh Mittal, the president of CII, and Prasanna, the head research at ICICI Securities PD, join us now to discuss Outlook 2019. Well, Prasanna, let me start with you first. Since you are the numbers guy here, what's the sense you're getting 2019? Are we going to do better in terms of growth than we did in calendar 2018? And are we going to get some fillip by way of rate cuts?
Well, I guess in terms of macros, I think like you mentioned, 2019 is shaping out to be better. I mean, at the beginning of 2018, we were seeing deterioration in external accounts on the fiscal side, and there were worries about inflation. Now, clearly, I think the inflation worries have, we have all kind of overblown it or overestimated inflation, both the RBI and the market analysts. As far as external accounts are concerned, of course, the way oil has behaved, it means that the current account deficit, it looks like, if I talk about FY20, it looks like undershooting 2% of GDP, which is a pretty comfortable number for India. So the only worry still remains in terms of fiscal deficit. So in terms of growth, our sense is that, and like you mentioned, I think we also expect a slight acceleration in FY20 compared to FY19. The positives, what we are seeing is that there seems to be some pickup in investment demand, although a lot of it is still driven by both the central and state governments. So on that aspect, I think it's possible that there is going to be a bit of a lull as we head into next year because of elections. So once the elections are over, again, activity should start picking up. Of course, the elections are a bit of a black box. It can also affect business sentiment, or it can boost business sentiment depending on the results. But by and large, yes, I mean, FY19, we are looking at 7.3% GDP growth, FY20, 7.4%. I think lower oil prices and lower interest rates should definitely help, even though the global growth is slowing down and is expected to slow down into next year. So that will be a negative for India.
Okay, so looking at a 7.3% GDP growth for FY19. We also have Rakesh Mittal, the president of the Confederation of Indian Industry, who joins in. Mr. Mittal, thanks so much for joining us. From India Inc.'s standpoint, what is the one big need of the hour? What tops your wish list to the government now?
Well, Lata, first of all, let me wish you a very happy birthday.
Thank you, sir.
And I must say that the year 2018 started well, with the first quarter GDP numbers at 8.2%, which got moderated to 7.1 in the second quarter. Having said that, I think this year we are looking to be a stable year for the Indian economy, including the global growth, which will be at about 3.7%, amongst the highest in the past few years. And I think also the oil prices stabilizing, the rupee volatility not there anymore, are the huge positives which I see, which I believe will continue till the March 2019. Also, on the GST front, we are clearly seeing more rationalization happening, and I believe that going forward, we should look at 2 tariff lines at best for the Indian industry. Okay. Strong reform processes have yielded positive results, and I believe with the general elections around the corner, the demand will upsurge. Okay. So I see these are the positives which will end the year and continue to the next year, 2019. Okay. Couple of risk factors which I see for 2019. February, we all know, U.S. Is slated to raise tariffs on 200 billion imports from China, which I believe there could be a huge disruption, but also simultaneously a huge opportunity for the Indian industry. To look at more exports and into the manufacturing and the services sector. You did talk about the fiscal deficit at 114%. While the finance minister has said that he's committed to contain it within 3.3%, but I think my view is, given the slower tax revenue growth and more expenditure on subsidies, Ayushman Bharat, or bank capitalization may look to be a little difficult.
Okay. Well, actually...
And in the recent times, again, the agrarian stress is once again, coming up to the fore, which is impacting the investments, capex investments from the India Inc.
Okay, Mr. Mittal, sorry to interrupt. Thank you very much for your greetings. Well, actually, let me play out, Mr. N. Chandrasekharan's letter to his employees. The point where he says that global liquidity is all set to tighten. Now, obviously, for a global giant like the Tata Group, that's an important issue. But a global tightening affects every part of Indian industry. Do you see that as a threat at all, Mr. Mittal?
Well, I would say, within India, if you see, the NPAs are now at 12%, and clearly the banking sector and the NBFCs are talking about huge liquidity crunch. While I believe the banks have liquidity, they are not willing to give credit and are more in a recovery mode. And I believe this is seriously impacting the MSMEs. And given that this year will be anywhere between 7.3 to 7.7, even if I look at Prasanna's number of 7.3%, I think there is a drastic need to have a rate cut in the interest, because industry needs that support for fresh capital investments. And given the few sectors are firing well on the back of growing demand, I think this is the time when industry will be willing to look at capacity expansions and capex investments for the future.
I'm glad you brought out the point about a rate cut, because Prasanna, I wanted to come to you on that. I mean, Governor Das literally stoked speculations of a rate cut, hours after he took on the job, because he did emphasize that supporting economic growth was within the RBI's limit. Tell us what you're expecting. 1, 2, and when would the rate cuts come through?
Well, at this point of time, we are not expecting any rate cuts, but that, of course, can change. So if oil continues like this, and we obviously will get one more inflation print, again, suppose we get a print closer to 2% for December, which will come out in the middle of January, and oil prices continue like this, say between 50 and 55 by the time of the February policy, then yes, I think the chances of rate cut do go up. In fact, it could come as early as February policy itself. What we are expecting, though, is a change in stance to neutral, because clearly I think the way global variables move, I think keeping a stance at neutral is the most appropriate thing, because risks are two ways, and therefore rates can also move either side. So that is the ideal stance for RBI. Now, one consideration which the MPC might have is, and we alluded to it, about fiscal risk. So if the government actually exceeds the fiscal deficit this year, and again, and although it being an interim budget, one would expect it's a good marketing opportunity for the government before the elections. So if they announce any large scheme aimed at the rural economy or the farming community, which would again entail use of fiscal space, and that might be a consideration, and that might force the MPC to hold back, even if inflation kind of argues for a rate cut.
Okay, but do you see the actual cost of funds for industry, for people like Rakesh Mittal, rising? One, because global central banks are crunching their balance sheet, and two, because the fiscal space is getting utilized, and therefore there's not so much space for yields to fall. Prasanna, do you think that cost of money can fall for industry, even if there is a rate cut?
Well, I mean, setting aside the rate cut for the time being, just to answer your questions on global liquidity, I would think that, I mean, the Fed is going to delay its next hike, at least till May or June, given the way markets have kind of reacted to the last rate hike. And anyway, we do expect the US economy to also start slowing into next year. But the more critical question, I think, like you pointed out, is the Fed is also contracting its balance sheet. Now, I think that's where I think the last comments, the chairman said that it's an autopilot. But I do think soon there will be a reconsideration on that, and there could be some tweaking to that balance sheet contraction also. So all said and done, I do think from a global side also, I do think monetary policy, I mean, it will continue to tighten, but probably not as much as it was in this year, right?
Okay.
So that could be one positive. Now, as far as the fiscal space taking up, or rather affecting interest rates, I think that's where the RBI's OMOs are definitely helping. So that has ensured that even with the fear of a fiscal slippage and with some low probability of extra borrowing, even with that, yields have come down. And I do expect that they could come down even further into the next quarter.
Okay.
And which would mean that even with the current level of corporate bond spreads, net-net, I think borrowing costs for non-government borrowers will also come down.
Okay, okay. That's very positive. In fact, that was going to be, I mean, I'm going to dovetail my question to Mr. Mittal on that. Mr. Mittal, it's the final question. We are being warned. We are using the next show's time. But I just want to ask you, there is a nascent capex cycle. We saw good order books in, Larsen & Toubro, in Cummins, in GET&D, in ABB. Do you think that cycle is kicking up? There may be a problem of banks not being a bit risk averse, but still it looks like private capex is coming back?
Yes, I would say certainly. We started the year April 2018 very well when few sectors announced capex investment of 1 lakh crores. And I think that was coming hugely on the back of rural demand, which went up. And there were few sectors which were really firing very well. Infrastructure, of course, with the public spending. And I think my view is that these are good signs for the Indian industry, good signs for Indian economy. But clearly, we need to bring down the cost of doing business and cost of funds for the India Inc. And I think more importantly, if I look at the MSMEs, they are the biggest sufferers. We had the parallel banking system through NBFCs. With the bond market drying up and their sort of revenues or incoming streams getting tightened, they have raised the interest rates by 200 basis points, and ultimately it's the MSME who's going to get hit the most on that. And I think this is something why inflation is, I would say under control and right numbers. But but having said that, just one, two quick points. One is on agriculture, Prime Minister's vision of doubling farmers' income.
Okay.
I think the time has come when we need to unshackle the sector. And CII has made 2 suggestions of ranking the states on ease of doing agriculture, as well as incentivizing the private sector to make huge investments. And the 4 sectors left out on GST must be brought back in. And to smoothen the thing, quarterly returns should be allowed for every sector, while the taxes can be paid every month.
All right, so sorry, we had to hurry you. We're completely out of time on the show. But take your points on board. Prasanna, you as well. Thank you very much for joining us. Both of you, a great 2019. And it's a great December 28, actually, for the markets. It's 1.2% higher on the Nifty Bank, and it's almost 1% higher on the Sensex and the Nifty. And it looks like India is going to ask Australia to follow on. 151 all out
so
in reply to our 447 declared. So good news all round. And on that note, we wrap up on Bazaar. Thank you very much for watching Trading Ideas on Chartbusters.